Look at the economy from a wide angle, and you'll spot a massive disconnect. On one side, households are sitting on surplus savings. On the other, ambitious businesses desperately need money to build factories, hire workers, and expand. If a family were to just hand over their life savings directly to a corporation, the risk would be astronomical. There is no day-to-day oversight, and if that family suddenly needs cash back, they have no easy way to get it. To bridge this gap, the market relies on a specific tool, the security. It operates as a regulated, standardized contract between the person saving the money and the business spending it. When an investor buys a security, they trade their cash for a legally binding asset. That asset grants them a direct claim to either partial ownership of the company or a share of its future cash flows. This contract is the mechanism that powers the market. It takes static cash trapped in bank accounts and converts it into the kinetic capital required to drive economic growth. That initial conversion happens in a very specific place, the primary market. When a company needs fresh funding to launch a project, this is where they go. They don't navigate this alone. The company hires a merchant banker, a specialist who evaluates the exact capital requirements and designs the structure of the security they are going to issue. If the company is selling shares to the general public for the very first time, they launch an initial public offer, or IPO. Established companies have other routes. They might issue a further public offer to raise additional funds, or bypass the public entirely through a private placement aimed strictly at large institutional buyers. No matter the route, the direction of the money is identical. Capital leaves the investor's accounts and flows straight into the company's treasury, where it is deployed to build physical assets. The primary market operates entirely as a one-way street. Its sole function is capital formation and corporate expansion. However, the company has already locked that investor's money into concrete and steel. If that same investor suddenly needs their cash back, they can't ask the factory for a refund. This is where stock exchanges step in. They form the secondary market, an arena designed exclusively to trade securities that have already been issued. When a stock changes hands here, the original company is completely out of the loop. The buyer pays the seller directly. The corporation receives absolutely zero new money from the trade. The secondary market does not raise capital. Its product is liquidity, the ability for any investor to exit a long-term investment whenever they want. But how can millions of anonymous buyers and sellers across the country trust each other to actually deliver the cash or the shares on time? You cannot trade directly on the exchange. You have to operate through a registered gatekeeper, a trading member or broker, who executes the orders on your behalf. And physical paper shares are long gone. Today, massive institutions called depositories hold and transfer all securities electronically in highly secure digital vaults. Even with brokers and digital vaults, a trade could still collapse if someone runs out of money. To prevent this, the ecosystem relies on a clearing corporation. Through a mechanism known as novation, the clearing corporation steps into the middle of the deal, legally becoming the buyer to every seller and the seller to every buyer. To guarantee trades without going bankrupt, it requires strict financial deposits, margins, from brokers before trading happens. It is this heavily regulated, largely unseen back-office architecture that enforces trust, preventing the daily market from dissolving into fraud. Zoom out, and you see the primary and secondary markets functioning as two synchronized halves of a single biological system. An investor is only willing to risk their money funding a business in the primary market because they know the secondary market exists to provide an exit route. Overseeing this entire loop is a central regulator, enforcing the rules to ensure both capital raising and daily trading remain fair and transparent. Companies raise funds, investors trade their positions, and the cycle repeats. This continuous flow of capital is what builds infrastructure and scales industries. The promise of liquidity in the secondary market provides the safety net. Without it, investors wouldn't take the risk, businesses wouldn't secure their funding, and the expansion of the modern economy simply wouldn't be possible.